Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Barry. It's fantastic to have you back on the podcast.
Good to be here.
Now, there's so much we can talk about, especially with your sort of quite expansive work that you've done in recent years. But one thing that's very important for everyone really, but particularly for people involved in macro, is around the inflation regime that we're in. So there was this whole notion of transitory inflation, non-transitory inflation. Central banks have started to cut rates around the world, thinking that inflation is going to revert back to 2% or lower. How do you think about the regime of inflation that we're in right now?
I think that central banks have to confront a more volatile environment in general, and a more volatile inflation environment in particular. So a number of the economic policy shocks that the world is facing with the advent of the second Trump administration, geopolitical shocks that will be affecting the world economy, will have implications for inflation. So central banks are going to have to be more adept. They're going to have to be faster on their feet in adjusting policy to inflationary shocks, and I think we will see more instances of inflation temporarily overshooting target, conceivably in different places temporarily undershooting target, and central banks are going to have to react. For the moment, I think central bank independence remains secure, and central banks like the Fed remain committed to their 2% target. The last mile is the most difficult. As we know, specialists refer to that as the Phillips curve becoming flat as you approach the 2% target. But absent real threats to the independence of the most important central bank in the world, namely the Fed, I think we can count on inflation hovering around 2% in the United States and other advanced economies, although it will hover in a different way given this more volatile environment.
You mentioned independence a few times there, and you wrote a paper recently where you used some machine learning techniques to have a measure of independence. Could you talk a bit more about that and where we are currently, you would say, in relation to how independent central banks, key central banks are, say the Fed?
So certainly the European Central Bank is the most independent central bank in the world because it's the central bank for 20-some countries, and all of those countries would have to agree to any change in the statutory nature and prerogatives of the ECB. On the other hand, pressure from only one White House could affect the de facto independence of the Fed. And we heard earlier in this week that you and I are talking, Mr. Trump making some remarks to the Davos World Economic Forum about how the Fed should follow his dictates and lower interest rates. Now, I think more rhetoric like that would make life more difficult for the Fed. I would expect Jay Powell and colleagues to stand up to the pressure, and that then could lead to standoff with the White House that might be resolved by new appointments, by the appointment of a different Fed chair in 2026, with implications for monetary policy. But I think those implications would play out over time in the way I just described.
And the most clear mechanism for a president like Trump to have influence over the Fed will be through an appointment of someone who's kind of loyal to Trump. That would be kind of the easiest mechanism for him to directly influence the Fed, rather than changing statutes or doing something like that.
Right. Changing statutes or attempting to change procedure through an executive order would be difficult. Would require congressional approval, would require assent by the courts in the case of some kind of dubious executive order. But if I recall correctly, Chair Powell's chairmanship ends in 2026, and his term on the board ends only in 2028, but another member of the board has a term expiring in 2026. So that's an opportunity for Trump to appoint a new board member, designate him or her as the new chair of the board. Here again, it's important to bear in mind that the chair doesn't make monetary policy, but it's made by a federal open market committee of 12, half of whom are appointed by boards of directors of the regional reserve banks, which have different political and economic colorations from one another. And the other half of the members of the FOMC are the board members in Washington, D.C., who serve long terms in office, by and large. So a new chair could make a difference. A lot of jawboning from the White House could influence outcomes. But the main thing that I think will influence outcomes will be the reaction of financial markets. I think serious steps to compromise the independence of the Fed would elicit very negative reactions from financial markets. And we know Mr. Trump cares about financial markets. He takes the level of the stock market as one gauge of his success. So there is some hope that the market reaction will restrain him.
And I do want to come to Trump in a moment about his policy, but before we do that, just continuing on the central bank line, one question I had was around inflation expectations. And what's been interesting over the last 3-4 years is that measures of longer-term inflation expectations haven't really become de-anchored, which suggests there's credibility of the central bank. Have you been surprised about that how well behaved inflation expectations have been, or do you think it will change going forward?
Well, I think the importance of central bank credibility and the commitment of central banks to their inflation targets, those values are deeply ingrained. So from that point of view, I haven't been surprised. Nothing that central banks have learned in recent years or over recent decades, I think, works to raise new questions about that commitment. But the political developments that we've already touched on could, in principle, de-anchor those expectations. Another interesting new development or recent development is that longer-term interest rates in the United States in particular, but more broadly, have not followed short-term rates down as central banks have cut their policy rates in response to the deceleration of inflation. So uncertainty can, in principle, de-anchor expectations going forward, but that political uncertainty has been contained so far. And for that reason, I haven't been surprised that expectations have remained reasonably well behaved.
Now, I do want to get to Trump, and he's had a whole slew of executive orders that come through. The ones that people are most focused on from an economic perspective are tariffs, trade policy. That's what's been the big focus, at least in financial markets. Now, you're an excellent economic historian. You're an excellent international economist. So you have a perspective here. Maybe we can start with talking about imbalances. So obviously the US runs a very large current account deficit. China runs a large surplus. Europe, in particular, Germany runs a large surplus. So, how from an economist, from your perspective, how should we think about these imbalances? I mean, is it one country stealing from another country, or is this just like an efficient way of just allocating resources based on comparative advantage? What framework should we use to think about imbalances?
Fundamentally, these imbalances, current account surpluses and deficits, arithmetically, they're simply the difference between a country's saving and its investment. So U.S. savings rates are mediocre. U.S. investment rates, on the other hand, are impressive because of tech and infrastructure and other things. So we in the United States don't save enough to fund all of our investment. We turn to foreigners to fund the balance. China, on the other hand, saves prodigiously and is able to fund its own investments. So it runs current account surpluses rather than deficits, and those are reinforced by export-friendly economic policies. China is much better at pumping up production than it is at pumping up domestic consumption. So that's another way of looking at the issue. Are these imbalances benign or malign? Are they healthy or not? I think the U.S. current account deficit is healthy insofar as it reflects robust investment in the U.S., but it's a problem. It's worrisome insofar as it reflects fairly mediocre savings rates. And the fact that China relies on exports, on flooding world markets for its merchandise in order to keep economic growth going, that's not a reassuring sign. The fact that it cannot encourage more domestic spending. Households are worried about financial losses on real estate investments. They worry about not having an extensive social safety net, so they save in order to rebuild those financial buffers. Those are signs of economic weakness in China. So I apologize for giving you the economists on the one hand, on the other hand answer, but there is both good news and bad news here.
Now, I've had Michael Petty's, on the podcast before. He's been a big sort of advocate that with these imbalances, we really have to look at China. Like, the implicit explicit take he has is that China has been suppressing domestic demand to boost its exports and as a result lead to higher savings rates. So it's really China's at fault, more sort of directly, and then that as a result leads to these big deficits in the US, and the US has a large capital markets, no capital account control. So naturally, all the savings get pushed into the US. So he kind of puts a lot of the weight on China. Do you agree with that characterization? The characterization in the sense of what's the right thing to do? Is it to focus on China and tell them to boost their domestic consumption and stop over stimulating their production side?
I always find Michael's work very stimulating and thought-provoking, and half agree with it. So in this case, I would invert the way you described Michael's argument and say instead that China's inability to boost domestic spending, domestic consumption in particular, leaves policymakers with no option but to encourage more exports if they want to keep production growing by 4 to 5% a year. So China does have a problem, and it foists that problem in part on the rest of the world by relying so heavily on exports in order to keep the economic machine there going. But if I look at this from the point of view of the US economy, what goes on in China does not really have a first-order impact on saving and investment in the US, which means if China was following a somewhat different policy, the US current account deficit would still be here. It would still be of the same magnitude. We would just be running bigger deficits with other economies to make up for the smaller deficit we were running with China. So we run deficits with Europe. We run deficits with South Korea. It's not only China.
Yeah, that's a very good point. Yeah, thanks for recharacterizing the framework there. Now, Trump's remedy to this is tariffs, or at least he's very vocal on tariffs. And one apparent change compared to Trump 1.0 seems to be this idea of a global universal tariff. So, in the past, with both Democrats and Republicans, we've had sectoral tariffs. We've had some country tariffs, but he's talked about global tariffs. So How do you look at tariffs? Like, number one, as a sort of general principle, and then more specifically, bilateral versus universal tariffs?
Well, we're going to have to wait and see about the selective versus universal point. I think we're still at the stage where we're hearing from the administration a lot of posturing about tariffs. Another aspect of the issue is that the administration and the Republicans in Congress want to cut taxes, and they have to fund those tax cuts. So for Mr. Trump in particular, a universal tariff is attractive as a revenue-raising device. There have been careful studies out of the Peterson Institute for International Economics in Washington saying that tariffs wouldn't raise a lot of revenues, wouldn't raise revenues sufficient to certainly to replace the individual or corporate income taxes, or even to make a significant dent in the budget deficit. As for the economic impact of tariffs, revenues aside, I think we can look at this from 2 points of view. The first one would be the efficiency or inefficiency of tariffs. What would their impact on supply chains be? What would their impact on the North American automotive industry be? There are these famous figures about how the average motor vehicle produced in North America, the parts and components go back and forth across the Mexican, US, and Canadian borders half a dozen times before the vehicle is finally assembled. And that's for efficiency reasons, that these plants in these different economies, workers in these different economies execute different aspects of the process at lower cost than their competitors in other countries, and tariffs in North America would disrupt that efficiency. So what the point, which is kind of intuitive for the motor vehicle industry, applies widely to global supply chains. Tariffs would raise costs. They would be inflationary, and an interesting question is whether they would be set off kind of inflation with persistence by disrupting supply chains. Prices would tend to go up continuously over time, which is what something central banks would have to react to strongly, or whether a 10% universal tariff would have a one-time impact on prices. And we know that central banks kind of look through events with a one-term impact. I don't know the answer to a one-time impact versus continuous. The other point I would make is, following on our earlier conversation, a tariff would uniform U.S. tariff of 10 or 20% probably would, again, not have a major impact on U.S. savings rates or U.S. investment rates. So it wouldn't do much to affect the trade balance and the current account. It would be offset by a change in the dollar exchange rate. So that too would kind of damp down the inflationary impact. And because of the change in the exchange rate, the administration's hope that this would affect the trade balance, the trade deficit in a major way, would be disappointed. And that would be another reason that we're kind of, the administration is setting itself up for a conflict with the Fed, which would come under more pressure to deal with this supposed problem that the dollar was strengthening.
Yeah. I mean, on tariffs, I mean, one thing Trump and some of his supporters have cited is that in the 1800s, the US, in terms of tax revenue, relied mainly on tariffs. And they argue that that was a great time for the US in terms of growth and so on. So what would you say to that as, as a parallel, as a historical reference point?
So the assertion that tariffs were the main source of federal government revenue before the income tax came in, essentially during World War I, that claim is a fact. That's correct. But tariffs funded a very much smaller government then, we could rely on tariffs because federal government spending was an order of magnitude less relative to the size of the economy than it is now. We spend more now on defense. We spend more now on social programs like Medicare and Medicaid for your international listeners, on public health. And those changes in what governments do, the magnitude, the size of the federal government, are not going to be reversed, Elon Musk and his efforts notwithstanding. So yes, tariffs were the major source of revenue then, but they didn't raise revenues commensurate with the size of government we have now. The U.S. economy expanded strongly in the period before 1913. It is true, not as strongly as it did after 1945 in the third quarter of the 20th century, for example. And the economy expanded before 1913, partly through Western expansion, physical expansion of the country. The frontier, settled frontier, moved west. So unless you think that the U.S. is going to annex Greenland and parts of Panama, we're not going to see major territorial expansion. And the other reason growth was reasonably robust before 1913 was, wait for it, immigration. So there are some important lessons to be drawn from experience before 1913. The idea that the U.S. can fund its government through tariff revenues would not be high on my list.
And now that we're going sort of historic, in terms of tariffs, the other issue with it is you could get retaliatory tariffs, and of course during the interwar period we have the Smoot-Hawley Act, and I mean obviously there's huge debate about what caused the Great Depression, but that's one factor. Is that like a fair sort of thing to look back to see that as a potential, that's a useful reference point for us to see the possible consequences of a global tariff war?
Absolutely. So I do think that tariffs and retaliation were a factor in the Great Depression. Again, I would follow the modern conventional wisdom and put monetary policy mistakes and financial crises at the top of my list of contributing factors, but tariffs and retaliation were not helpful, and the geopolitical tensions to which they created erupted full force after starting in 1939. So there are lots of things, worrisome lessons from that history in the current context. I think the Canadians, the Europeans, the Chinese have all made clear that they will retaliate, as they did in response to Trump 1.0's tariffs starting in 2018, when they really came fully into force. And we've been reminded that the Chinese can not only meet U.S. tariffs with their own tariffs, tit for tat, but they can also embargo exports of rare earths. So China has only a fraction of the world's lithium, but it has the vast majority of the world's lithium refining capacity. And that's not something that we can replace quickly if China responds to Trump's tariffs by embargoing exports of refined lithium.
And how do you think about security concerns around, the US wants to stop tech development within China, and they have security concerns, whether it's from Chinese electronic products coming to the US, TikTok, all of these other sorts of things. They want to ban BYD, the auto, company's products. Is this, just an easier way to stop competition, like what we saw in the 1980s, where the US basically tried to block Japanese exports as much as possible because they were just cheaper, and there was a risk to US companies' market share? Or do you think there is a genuine sort of geopolitical thing here where it's like Cold War II, but with China?
Yes and no. I think there are valid security concerns and invalid security excuses, both. And that's obviously the way politics work. So my view is that by and large, the Biden administration got it right on TikTok and Huawei and some other cases. But it's not surprising that U.S. companies that want protection from Chinese competition invoke potential security concerns at every turn. So I would rephrase a little bit from the way you put it, that the US is not going to be able to prevent China from developing frontier technologies and developing technologies that pose potential security risks to the United States. What the US can, and I don't think embargoing US exports of the latest generation of chips and chip making equipment is really going to work for very long, because China is developing its own substitutes for those. But what we can do is limit the use of those technologies and that hardware when produced in China and potentially containing a backdoor of some sort. We can limit their use and application in our countries.
I wanted to talk a bit more about the dollar, a couple of different angles, but one in relation to trade policy. In the executive orders, there was a reference to dollar valuation, what's the contributing factor of dollars to global imbalances. And so one potential policy could be to weaken the dollar to address the current account imbalance. We had the Plaza Accord in 1985. That was a very overt action to help turn the dollar and then deal with trade imbalances. And there's been other kind of efforts, coordinated intervention, in 2000 with the Europeans, and then Japanese intervention 2 years ago. Number one, I mean, what's your view of being more active on the FX side for the US? And then number two, do you think it's possible that there could be some kind of accord like Plaza?
Again, I think President Trump and company need to be careful what they wish for, because strenuous efforts to talk down the dollar would meet with a negative reaction from financial markets. I think higher U.S. interest rates, which are the last thing that this president and administration want. The most direct way of weakening the dollar is to put pressure on the Fed to cut rates. And again, I think pressure would elicit a negative reaction from the markets. There are then some really harebrained schemes to weaken the dollar, like taxing interest payments on U.S. Treasury bonds held by foreigners, held by foreign central banks, as a way of discouraging them from buying U.S. securities, the purchases that tend to strengthen the dollar. And financial markets would really respond negatively to that kind of intervention. So that leaves you with your Plaza Accord idea, or hypothetical Mar-a-Lago Accord, where essentially might involve the Fed loosening a little bit, and foreign central banks, the European Central Bank and the People's Bank of China, tightening significantly. That's what we're talking about. So in 1985, when we had the Plaza Accord, the European and Japanese economies were reasonably strong, and inflation was a problem. So their tightening wasn't out of bounds. It wasn't a ridiculous idea. Now, growth in Europe and Japan is not strong, and incipient deflation, not inflation, is the problem. So raising interest rates
in China rather than Japan this time.
In China, exactly. Increasing interest rates is the last thing that the European Central Bank and the People's Bank of China have in mind. You are correct that the BOJ raised rates this week modestly. Japan is an interesting counterexample, but if there were to be real progress on strengthening foreign currencies and weakening the dollar, it would have to come from Shanghai and Frankfurt. And that's the last thing those central banks would be inclined to do under current circumstances.
Okay, so FX policy sounds like a very bad idea to use that, but let's see if that happens. How about the other aspect of the dollar? And this, people always talk about this, the end of the dollar as a dominant reserve currency, or dominant however you want to define it. I mean, how do you think about the dollar status globally right now?
So the dollar status globally has not weakened significantly in response to events, whether those events were the global financial crisis, the failure of Silicon Valley Bank, the sanctions that the Biden administration imposed on Russia, which involved weaponizing the dollar in the sense of freezing Russia's dollar reserves and its access to the U.S. banking system. None of that has significantly changed the status quo, which in which the dollar is the dominant international currency. It's caused Russia to turn away from the dollar dramatically and increase its reliance on China and the renminbi. But more broadly, what it's done is encouraged central banks and governments around the world to look around for alternatives. There are not a lot of attractive alternatives at the moment, but there is a lot of active looking, and there are efforts on various margins like China's continued development of its cross-border interbank payments system, which is an alternative to SWIFT. Again, a mechanism in which the U.S. has a big say. Central bank digital currencies and their potential cross-border use through an mBridge-like mechanism. Again, an initiative in which the PBOC has a leadership role. I think those alternatives are being experimented with, contemplated, and over time are likely to provide a hedge against dollar dominance. So I'll remind you of my 2011 book, Exorbitant Privilege. I predicted that as we move toward a more multipolar world, we will move toward a more multipolar international monetary and financial system in which the euro and the Chinese renminbi are more consequential alternatives to the dollar. I was overly enthusiastic about the idea back in 2011. Movement in that direction has been slower than I would have anticipated, but I think it's likely to pick up speed now. And I think that new digital technologies, something that whose potential I didn't fully appreciate in 2011, none of us did, create payments and financial alternatives to relying on the dollar when you do cross-border transactions. So the dollar is still on one side of 90% of global Forex transactions, but new digital platforms, I think, will over time create alternatives to going through the dollar when a Korean company wants to buy Brazilian reais, it first buys dollars and then sells them for Brazil's currency. It will be able to go direct when these new digital platforms are fully rolled out.
And what stopped the Chinese renminbi from internationalizing more faster?
Well, it is internationalizing fast, but it's starting out so far behind the dollar and other fully convertible currencies. If you will, renminbi internationalization has been a thing only since 2009, when the then governor of the People's Bank of China made the first speech, if you will, about the subject. By some measures, cross-border payments through CIPS, China's international bank platform, are growing by 50% a year, but starting from a very low level. So given that dollar payments are growing as well. The calculations I've done suggest that it will still take a couple of decades before the renminbi comes within hailing distance of the dollar as a vehicle for cross-border payments.
And when you talked about the dollar earlier, you talked about taxes on US debt and long-term interest rates. So that brings us to the big kind of question of our day, which is the level of public debt in the US, but also elsewhere. And again, it's like one of those dollar questions, when's the crunch time for the US debt? First, I mean, how do you think about, trying to answer a question like that? Like when does it become a problem?
Well, whenever somebody asks me, I channel the late, great Rudy Dornbush, the MIT international economist, about how crises come later than you thought typically, but when they erupt, they're even more violent than you thought. So I think the U.S. government and its debt have still some room to run, but I'm not reassured by that fact, because when we finally run into the brick wall, the fallout from that could be quite violent, quite painful indeed. So U.S. debt in the hands of the public at the moment is about 100% of GDP. And we're reminded that Japanese government debt as a share of Japanese GDP is on the order of 250%, closer to 150% if you're talking about net debt, net of the Japanese government's assets, the land and other assets that it holds. So even with a budget deficit of 6 or 7% of GDP, you do the arithmetic, and it will take a decade and longer, even if nothing is done, before we approach Japanese territory. It's important to bear in mind that Japan has some advantages in terms of managing that debt that we don't have in the United States. Higher savings rates and a captive market for that debt in Japanese insurance companies and pension funds, which hold a lot of it. So the Japanese comparison is relevant. It's apposite here. It indicates that we do have some room to run, but that the crunch is going to come before we reach current Japanese levels of public debt. I did a paper for the Federal Reserve Bank of Kansas City's annual Jackson Hole Symposium a year and a half ago about this problem. And my co-author and I found that there were two robust predictors of when governments are able to get their arms around these kind of debt problems and narrow their budget deficits, stabilize and bring public debts down significantly. And the only two robust correlates were rapid economic growth. And we can speculate, we can argue about whether U.S. growth prospects will continue to be rosy, as they are at the moment, and low levels of political polarization, which are definitely not a characteristic of the United States at the moment, when the different political wings or parties are able to agree on a strategy for narrowing the budget deficit, and they're able to stay the course over time. So if you look at the United States or you look at France, another case in point, at the moment, political polarization is a big obstacle to dealing with this problem.
And, I suppose a related point is term premia and US interest rates. We've had this unusual period for the last 10 to 20 years where term premia has been flat to negative. The curve has just been remarkably flat, even inverted, even as US debt levels have gone up around the world. It seems like, and you touched on this, the last 3-4 months are starting to change. Long-term interest rates are starting to go up. Maybe it's related to the debt issue, maybe not. How do you think about something like term premium, or how long-term rates markets sort of price this type of risk?
So I have not seen convincing research that pins down the sources of the change in the term premium. It could be the first glimmerings of concern about the sustainability of U.S. government debt, or it could simply be the effect of an unusually high level of political and policy uncertainty in the medium and longer term. That's how I think about it, but I don't have a strong view because I don't think we have convincing research yet, convincing evidence yet on what is a pretty recent development.
And I mean, this may be sort of too difficult to do, but if you were in the administration, the Trump administration or a administration, and you had to deal with this debt issue, and let's say you did have more bipartisan support, I mean, what types of things would you look at to bring the debt levels down? You know, people have talked about government efficiency, but often that's kind of a loose thing that doesn't seem clear. The other one is level of entitlements that has to be addressed somehow. There's tax hikes. I mean, what would you say would be the things that a Treasury Secretary or administration should look at?
The answer I'm about to give you is a reminder that I am a professor and not an active policymaker at the moment. But I think there is very limited scope for doing much on the spending side. There is no scope for compressing defense spending. There is very limited scope for compressing entitlement spending. So I think we should revisit the question of retirement age and ages at which Americans can begin to draw Social Security benefits. We should think about means testing Social Security. So that's a very controversial idea. Social Security, our national pension, is widely supported by the public and the politicians, in part because it's universal. Everybody gets it, regardless of their income and wealth. But I think there is an argument that higher income, more wealthy retirees might have their pensions limited. But the main place where we can make a difference is on the revenue side. So it's simply a fact that the U.S. is a low tax country by advanced economy standards. I'm not suggesting that we should raise taxes here to French levels, but I do think there is room to make progress on the deficit on that front. And I am therefore worried that the direction of travel in Washington, D.C. at the moment is the opposite, cutting taxes on tips, cutting taxes further on corporations, cutting taxes on all kinds of things, which I remain a believer will worsen the deficit problem rather than improve it.
And I just wanted to round off with some recent work you did on the international monetary system in the very long run, as in centuries. Can you sort of touch on some of the findings you had in that research?
Well, international currencies rise and fall over time. Greek coinage in the era of ancient Greece was used throughout the Mediterranean and in parts of the Middle East. Roman coins, similarly, were used everywhere from Asia to Scotland during the period of the Roman Empire. So we've seen international currencies in this very long run of multiple millennia. They tend to gain popularity in periods when an economy is a leading trading power, but also a leading military, geopolitical power. And this kind of leadership, be it commercial or geopolitical, doesn't always last forever. So we see international currencies rise and fall. And sometimes the rise can be a factor in the fall. So this is Mr. Trump's worry that international use of the dollar causes the greenback to become richly valued or overvalued, which works to the detriment of the US economy. And we do see elements of that in the earlier history when the florin, the currency of the city-state of Florence, was the leading international unit throughout Europe. Its high value worked to the detriment of the Florentine wool industry. Or when the Dutch guilder was the leading international currency, its rich value worked to the detriment of Dutch industry. So there's something to this. International currency status has benefits as well as costs view. And the other thing I would say is that while we do see international currencies throughout, dominant international currencies throughout history, I've named a number of them that correspond to different historical eras. There is always international currency competition as well. Each of these dominant international currencies had significant rivals. So again, I will not be surprised when significant rivals to the dollar as the dominant international currency develop in the not too distant future.
Okay, that's fantastic. I mean, we've covered a lot of ground, so I really do appreciate your time here. And just the final thing, what's the best way for people to follow your research and follow you in general?
I write a monthly column for Project Syndicate, which is a great outlet for your readers to follow more generally. And happily, with the help of a student, I've just updated my UC Berkeley website. So I have a personal website linked to the economics department here at Cal, and all my scholarly articles, but also my popular columns and so forth now appear there with a web link that you can click through on.
Great. I'll make sure to include the links to both on the show notes for this. So with that, thanks a lot, Barry. It's fantastic to hear from you again, and good luck with all your research endeavors.
Pleasure to talk with you as always.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.